freedom isn't the result of wealth, it's the foundation. Welcome to Wealth Independence, where freedom leads and real wealth follows through battle-tested strategies, hard-won lessons, and real-world experience. You'll discover how to accelerate your path to true financial independence. And now your hosts, Dustin Bailey and Adam Penn.
All right, welcome back to the Wealth Independence Podcast, where freedom leads and real wealth follows. I'm Dustin Bailey. I'm here with Adam Penn. Adam, what's up today?
I don't even know why we record that anymore, because you say the same words every time.
I wear different shirts.
Oh.
And sometimes the lighting's different.
You wear the shirt in this partnership, you would say?
I suppose so. You know, the AI has gotten good enough now. I suppose we could just we could just AI the entire intro, right?
This might not even be us. Have you seen those videos where they're like, it's like a guy, but like they make it look like a girl and like they can move the hands around? And it's like it's impersonating the person.
Yeah, that's you're right. So can I even trust that I'm like talking to the real you, or is this your AI avatar?
The AI can't make things as ugly as this.
Well, that's a fair point.
Okay.
That's a good tell. You would hope if you're going to make something up, you'd have it be a little bit better than that. I'm just kidding.
Do you want to talk about the episode now, or you're just going to keep insulting each other?
No, it's fine. Yeah. So, I don't know. This was something that came up recently in a investor conversation, and I had heard this for years, and we kind of experienced this, I think, for the first time really ourselves last fall with a bigger deal. But it's just that I think there's this misconception that people have when they start to invest in real estate. They're like, well, I need to start with a small deal. And whether that's like, even if you know about syndications and investing like completely passively, I've still talked to investors before that are like, well, never really done anything in real estate before. I think before doing that, I'll go out and buy a single family home and I'll just learn about it. Okay. That's better than not doing anything. I will completely agree. But at the same time, there are many, many benefits to larger deals that you get over smaller deals. And larger deals tend to be easier to get done, whether it's you that's executing it or if you're partnering with other people. And so I want to challenge this somewhat conventional wisdom of starting small and thinking that you actually don't have to, because it can be easier to do the bigger deals. And there's a handful of different reasons. So that's my idea for today's podcast. You got any initial thoughts on that one?
I think it's the few thoughts that came while you were talking about that were that when you start with a small deal, especially when we're talking to investors and stuff, right? And they give you the same story you just said, right? There is, I want to invest in real estate, but I feel like I should start with my own property, right? I'm going to buy the single family home down the street. That could leave a bad taste in your mouth, right? Or maybe they're going to buy an out-of-state rental, right? They've heard that's the thing to do. And to your point, it's not always easier, right? I would say that if you're the type of person that wants to be really involved, that wants to kind of have this be your profession, for lack of a better word, maybe it's your second profession, but like, when I started buying real estate, like I worked a 9 to 5 and then I went and worked on the real estate for another 4 hours, right? Like when I was remodeling my first home, I worked till 4 p.m. and then I worked again until about 9 p.m. And that's how I did it. It probably would have been a lot easier for me to just go invest in a syndication. Now the returns might not be the same, right? But the returns on your time are probably about the same. If I counted all the time I put into real estate, I honestly might have been better just to put money with someone else. But that's what I enjoy doing. So I really think that's kind of my first thought about starting small and getting bigger is when you start small by yourself, you are the team, right? You might not be the real estate agent, but let's be honest, most single family real estate agents aren't really broker investor types. They're even the smartest ones I know really to just kind of push paper, and maybe they'll guide you in the right direction a little bit, but especially out here in California where your average house is $500,000, I don't think they're worth $25,000 to to move some paper around to execute a contract. I'm surprised title companies haven't taken some of that over. Anyway, I digress there, but you're going to find the property most likely and then engage a real estate agent. You're going to evaluate the rehabs or manage the contractors doing the rehabs. You're going to manage the tenants, probably at least in the beginning, or you're going to hire a property manager and then pay them a fee for it. So you're going to do all of these things, plus sign on the debt, plus put all the capital down, plus have the single asset. I think, and I personally would not be opposed to this at all from any of our investors, assuming they were, I don't want to say easy to work with, but easy enough to work with. I think you would, if you went to a syndicator or someone, you said, hey, I really want to invest in your deal, but you guys do weekly or monthly like management calls, right? Can I be on those? And I wouldn't object to any investor saying that. I'd say, sure, there's going to be times you hear things that I'm going to say, like, try not to chime in, or like, well, I'd love your opinion, but like, a lot of times we'll discuss things we're not sharing with all the investors. And that's not to hide it, but that's because maybe we haven't made a decision about how we're going to refinance something, or is now a good time to sell, or, we have a property right now, we have an off-market deal on, or someone has made an offer, an unsolicited offer, but I think it's way below market value. So we're not going to go present that to everyone when it's really just a looky-loo. We don't have a formal offer or anything written. It was kind of like would you take something in this range? Let me look at a P&L type of thing.
No, I think that's good. And you kind of took a slightly different direction than I was approaching it. But I think you're spot on into that last part about if anyone wants to, if we had a passive investor that wanted to be on that more active side, I don't think any of us would have any sort of issue with that. But I think that the bigger point there is it underscores the fact that this is like when you start going bigger, it's a team, right? And that's good and that's bad. It means you can get more done. You're spreading out the work. I think you painted a really good picture of when it's just you, like all the stuff that you have to do. And then as the deals get bigger, you just can't handle it. And so going bigger, you do have to have a team, but that's nice because now you can spread it out and everyone can kind of specialize in things that they tend to naturally be better at. I think for me, I mean, one of the things that I think about when doing the bigger deals is just that I think they're easier to get across the finish line from a financing standpoint, particularly. But really from just like all the parties. So again, talking about a team, you do the bigger deals, you have a lot of people that get involved, right? And if you want to bring others into small deals, like obviously you can have a team, you got your banker or maybe a property manager on a single family home. But the bigger the deal, the bigger the pie, right? And the more there is to go around for everybody. And so that's probably the biggest thing to understand is that naturally means that people are going to be willing to give a larger deal more of their time, right? And so if you've got, like we saw this on a, what was that? Like a 210 unit building in Las Vegas we offered on last fall.
Rosewood?
Yeah. That was like, everybody was coming out of the woodwork to help us with that deal, right? It was like multiple lenders were like, hey, we'd love to lend on this. And property managers were like, oh, this is a great thing for us to manage.
Insurance brokers got quotes back in 2 hours. And then I emailed that same insurance broker the other day for a 20 unit. And he's like, we don't quote things that small. And it took him 2 days to get back to me.
And I think that was a perfect example to us of I mean, the numbers are big and there's a lot of work. There's no doubt about that. But at the same time, like when you've got all these people now, because they know it's going to be more worth their time, it makes it easier to actually get it done because you've got a more motivated, a more bought in team. And so that's the thing that I think, again, I had heard that for so long, and it wasn't until we were actually going after a deal of that size that I really saw it firsthand. And it was like, man, this is a lot easier. Like we're getting responses from people. We're getting like all the information. It's normally like pulling teeth trying to get from folks. We're getting without any problem. Everybody's ready to jump in on this deal. And some of it was because it was a good deal, right? Like it was something that I think everybody kind of saw that, but at the same time, they also saw the size of it and their potential cut or, the exposure they were going to have in their business.
I mean, you could go to a property manager with 5,000 doors and you're still talking about, help me with the math here. If we added 200, it'd be 2%, right?
Yeah.
I mean, that's Is it
1%.
1%?
I don't know, what'd you say?
200 doors?
200 on 5,000?
Yeah.
Oh, it's 4%.
There we go. 4%. We're good at math, I promise. It'd be 4%, right? I mean, that's not a huge amount of their business, but I mean, that's a guy with 5,000 doors, right? I mean, you talk about a property manager managing a single family rental, and you bring them managing single family rentals. If they have 5,000 doors, which that would be a lot, that'd be a huge property manager. But you bring them a duplex, you're not even touching the threshold, right? I mean, they could lose 200 of those and they're only touching 4% of their business, right? So, and most property managers I think we worked with are in the 2,000-ish spot. So you're talking 10% of their business then.
And it's the same thing with, every other service provider like that. That's a crucial team member to getting these deals done. I mean, even you look at a mortgage broker that might charge a 1% origination fee on a $20 million loan, right? Well, that's $200,000 in one fell swoop.
Mm-hmm.
And so they obviously they're motivated. Same thing with the insurance brokers. So it's one of those things that, like, again, I think it makes intuitive sense, and I had understood it and I had heard it from so many people, but it was just something else to really experience it. And so that's the thing, that's the challenge that I always give to someone that, if I'm talking to an investor and they're thinking about maybe being a more active real estate investor and like, well, I think I need to start small. If you don't have the experience, it's good, right? You don't want to get out over your skis off the bat and try to go big at something that you're just going to completely implode. But at the same time, I think you also need to recognize that there doesn't have to be this like slow burn ramp up period to being able to do deals. And you could think, well, I got to get started with one house. Like, well, I'll spend the next decade just buying a handful of houses. Like, that's probably a little bit too long of a time frame for something like that. And everyone that I've ever talked to has said, man, I wish we'd started doing these bigger deals sooner for this exact reason.
The kind of last thing there, and I think I want to change the topic slightly, is just that if you go out and buy just one house, you say don't get out over your skis, but that one house could be over your skis, right?
Could be.
Compared to just writing a check and letting a team manage it,
yep,
you now have possibly a lot of little things you've got to deal with and calls. And I mean, you've got to deal with the property manager. You've got to deal with if you get a good property manager, you only have to deal with the property manager, but you've got to deal with that, or let's just say the lender, you got to personally guarantee it. You got to do all the things. If there's a repair, you got to come up with the check. Did you put reserves in there, or were you cutting things thin because you were buying it yourself? There's a lot of little things like that. I'm 100% for everyone owning their own property and going out and buying stuff themselves. I just think that you just have to see if it's right for you. And there are people I know that would not want to own real estate, but would 100%. Be happy investing in it.
Absolutely. No, it has to be aligned with what you want. Otherwise, it's going to just be a miserable time. And that's one of the reasons I absolutely love syndications is because you can tag on to another team that's getting the benefit of doing these larger deals and the ease of getting them done and the economies of scale that come with it, and generally the better returns and things like that. And you get those benefits and you're not doing any of the work.
I was talking to a buddy the other day. We were buying a 20 unit and he said he was putting $100,000 into the partnership. It was about, let's just say that's about 20% of the ownership. So that's 4 units. He's like, so I can just write a check for $100,000. I'm going to own 4 units. And he's like, I can't buy 4 units for $100,000 anywhere else. Yeah. And I don't have to really actively manage these. It's just
25 a door.
It was just an interesting way to look at it.
It is. I've never thought about that before, but that's a really good way to look at it. Yeah. Where else can you, under what other model can you buy rental real estate at $25,000 a door and you don't have to do any work? It's great. Well, did you say you had a different direction you wanted to?
Yeah, I think the next thing to kind of talk about on this topic is, and I don't know how long you're wanting this episode to be, but if we dive into, we've talked about, if you're just getting started, do you buy the single family, or do you invest in the 20 to 100 unit apartment building? Well, the other option is, and this is where a lot of people I know that are in the big buildings kind of moved from, is, I have a handful of rentals. I'm done with this duplex, single family type of thing. How do I get to this next one? And I think maybe I'll just lay out a few things and you can kind of choose how you want to go. And real quickly, I will mention if people like this content, if they're enjoying this show, like please do leave us a review, send it to your in-laws. Or that might work. If you don't like your in-laws, send it to your in-laws. And we'll just see, obviously leave a review. It helps us grow this. We don't do a lot of ads and stuff to really grow this. So back to the topic of the show here, we have a single family. Let's just say you've owned one home and it's gone up in value. You paid down the mortgage a little bit and you got a few $100,000 of equity. You could sell that and maybe you're going to pay capital gains on it. Maybe you've got some other tax benefit thing. Maybe your basis was high enough, whatever the story is. Maybe you have a few $100,000. You could roll that off either into a bigger building yourself, into a syndication with a larger building, or maybe one thing I've seen a lot of people do is they'll do like a tenant-in-common agreement. And they'll get 3 of those guys, right? You get 3 people that all have a single family home worth $200,000 a piece. You guys collectively agree you're going to go buy I think you could get a 30-unit building. You're going to go buy a 30-unit building and put $200,000 a piece down. Maybe you all sign for the debt collectively, however you need to structure it with the bank. And you could all 1031 do it. You're not going to have taxes. You're going to just move your basis on over. And now you've taken your single family or duplex and turned that into a 10 units, right? 10 units that you own in collection with 2 other people that also own 10 units for 30 in total. And I think that's probably the most common. It's not necessarily that there's always going to be a tick structure like that you're going to do. But I think that, or you can always refinance that, take some of that cash and put it into a syndication. Just kind of depends on what what your individual portfolio looks like. But I think a lot of times what I've done is cash out, refinance, and move those into bigger deals so that we can still hold the old ones. Primarily because we have really good debt on the old ones, right? We're sub 3% interest on a lot of them.
Yeah, no, I mean, there's plenty of different ways to, I think, approach that. And that's definitely, again, like trying to think about ways to partner. It's not always just syndications. Obviously, we love that, but I think even that idea of ticks and something like that to start getting the benefits of doing those bigger properties, even on bigger properties on a smaller scale, I think is always a really good alternative to just staying in the single family lane and just trying to do all of that completely on your own account. I think eventually you get constrained at some point, right? Like you really on your investing on your own, you really can only grow so big. You eventually hit a limiting factor. Usually it's around the debt, right? The banks say, hey, you've got way too much here. We're going to stop giving you this. And so at that point, it does become a question of, okay, how are we going to fix this? What am I going to do to continue growing this? Or you just say, well, I'm content where I am, and you kind of stop. But yeah, definitely plenty of ways to go bigger and start getting those benefits. I don't know. That's honestly the big. I'm looking at my notes here from this. I mean, that's honestly the biggest thing. I would always whenever I hear someone say this, I would say, well, just don't assume that that's always true, right? Like you definitely need to. We've had a recent episode on making sure that you are educated and you're taking the time to learn what you're investing in, and that should always be true. And you don't want to do something that's going to be absolutely ridiculous as your first deal. And again, whether that's a single family home or it's a large apartment building, you don't want to do something that's totally outside of your wheelhouse right off the bat. But at the same time, don't think that it has to be this like start small and then slowly scale into these bigger deals. And it also doesn't mean that you have to, in order to get exposure to the bigger deals, that you have to be doing them yourselves. There is that passive way to go about it as well.
I think every situation is just a little different, but obviously, look at what makes the most sense for you. We talked, I think, recently about personal financial statements and building those out and really seeing it on paper and just letting the math kind of tell you what direction you want to go. But I think there are a lot of opportunities out there. And just because a 30 unit or a 20 unit or 100 unit seems daunting doesn't mean that it's not possible and that you couldn't do it either through an investment with someone like us or by just doing a partnership with 1 or 2 other people.
Yeah, for sure. That alignment, like understanding what your own goals are and what you want to achieve out of it, that's more important than anything else. And then structuring the path to go that way. Because if you if you want to be doing the work and you're investing passively and you're feeling left out and unfulfilled by that, then you're just going to be unhappy, and vice versa. If you were looking for a completely passive investment and you decide you want to go out and buy a single family home and be a landlord, you're going to be also very unhappy and quite surprised. So you got to kind of do that introspection first and understand what you want, and then make sure that you align your deals or align your investing strategy methodology around that. Well, good deal. Adam, anything else on this one?
Nothing for me.
Nice. Well, we will get on out of here. We appreciate everybody listening. Thanks so much. And just remember, where freedom leads, real wealth follows. We'll see you next time.
Thanks for joining us on Wealth Independence. This show is for informational purposes only and is not financial, investment, legal, or tax advice, and does not constitute an offer to buy or sell securities. All investments carry risk, and investors should always conduct thorough due diligence and consult with qualified professionals before investing. Until next time, remember, freedom leads and real wealth follows.